Welcome to the All Financial Hour podcast with Steve All.
When it comes to retirement confidence, it appears many just don't have it. There was a recent survey that found that Americans age 50 and older who are not yet retired never expect to. Yet more than 60% in that age group have not even consulted a financial professional like yourself, Steve, to help them when it comes to retirement planning. So, I mean, I can see the disconnect here. You don't have confidence because you don't have a professional helping you here, right?
You know, I look at it at a point, people just aren't sure. And I think a lot of it is, you know, you hear these articles where you got to have 1.5 million, or I've heard it's like $3 million to be safely retired. You know, and I always bring in the story. You know, I had a doctor come in with 2.7 million, and then I had a couple come in with between $300,000 to $400,000. You know, and I always ask the question, which one do you think could retire? Mm-hmm. Well, the doctor couldn't. Well, he goes, wait a minute, I got $2.7 million. What do you mean I can't retire?
Right.
I said, you spend about $250,000 a year and you're 62 years old. That's not, you're not going to make 10 to 12%. You'll run out of money. Well, he didn't like that idea. You know,
I bet
and
not,
then,
yeah.
And then you got the other couple, Kathy and Don. They come in. They got $300,000 to $400,000. They've got like 5 or 6 401ks, 2 to 3 pensions, Social Security, and a very low lifestyle. So we did what we do. We put together the comprehensive retirement plan, and we brought it down and we looked at it. Well, your income's being met. 2, your risk rewards within line of what you're talking about. And you look at those things. Now, I didn't have to worry a lot about taxes because they didn't have a large nest egg, and I wasn't worried about a tax thing. But if you're in that position and you're not sure if you can retire or not, give us a call. Let's sit down. Do that comprehensive retirement plan. Let's figure out what the chances of you having a retirement. Because you, just like a lot of other people, might be able to go ahead and retire. But until you actually run the numbers for it, you're never going to know. And that's where I think that people need to find out, 1, can I retire? Will I run out of money? And that idea around it of it is what is your lifestyle is the most important thing when we're doing a financial plan. Not how much you have, it's how much you're spending and what kind of income you need. Give us a call now. Ask for that comprehensive retirement plan.
You know, we've talked a lot about the Magnificent 7 stocks and how they've held up the stock market. This year, we've seen a little bit of a reversal. Only 3 of the Magnificent 7 are doing well. But Jack Otter tells Barron's the others outside of those 7 are catching up.
The good news is that we've seen a broadening in the stock market. So it's not just the Mag 7, which actually are not doing so well. But I think 80% of stocks, 75% of stocks are above their 200 days. So that's a good move.
Okay, interesting there. So if you've been holding back from re-entering the market, is now the time to just jump in?
Well, I mean, I think that's always the question that everybody asks. You know, those 3 major questions. When do I hold? When do I sell? And when do I re-enter the market if I've made the decision to leave the market? And I think that's the big question that most people have. I had a gentleman call the show. You know, he said, you know, in 2007, I felt the market was going down. And so I pulled my money out of the market. And he said, you know, I felt pretty smart in 2009. You know, after the fall of the market, you know, everybody again was talking about how their 401ks had become 201ks. He said, so I felt pretty good. He said, Steve, but I'm still sitting in cash. That was in 2019. The guy had missed 10 years of a very highly moving in an upward direction market. Had some bumps in it, but it went from there. And that's where we start to get at is where are we currently at? And I think having that market guard, that proprietary investment methodology that uses a non-emotional, mathematical, methodical way to invest is very, very important. Let's get the emotions out of it. I think that's the biggest thing that we could possibly do, because I'll get people that'll come in and they'll ask that exact same question right now. Well, where are the markets at right now? And that's one thing I love about the market guard philosophy. Brad Jenkins does a great job. He's got static portfolios where we stay fully invested. We've got individual stock portfolios that are more aggressive portfolios. And then we have what we call tactically managed portfolios, where when markets are crazy like they are right now, they might not be 100% invested. So instead of just sitting on the sidelines, We can put them in our target models that are not fully invested right now. And when mathematics and the formulas say it's time to get 100% reinvested, it'll move that stuff back into the market for you. So you don't have to make that decision. And I think that's what makes it, because emotions are the hardest things to remove in the investment world. Why? Because people start to feel really good when markets are high and they don't want to move away from it. Mm-hmm. And then when markets start to drop, and then they get real low, and then people get discouraged, and that's when they sell. And I think that hurts more people's returns than anything else. If you've been asking yourself, is it time to hold? Is it time to buy? Or is it time to sell? Call us now. Ask about Market Guard. Let us do a risk-reward analysis and figure out where you're at and which would be the best model for you and your risk-reward tolerances.
And again, this is a complimentary opportunity for you to ask more about Market Guard. How does it apply to you in your specific situation? Then, of course, this risk-reward analysis really kind of lays it all out for you and gives you a better point of view of how much risk you are or maybe are not taking. 636-230-8824, 636-230-8824. And I want to go back to something you just mentioned here, Steve, about how emotions, they're the hardest thing to remove from this decision-making process, from this conversation. But if you think about it, it's the truth. I mean, we are emotional. This is our life savings. This is everything we've worked so hard for. So how do we, when we sit down with you, our member of the team, how do we go, okay, we're going to trust you and we're going to take our emotion out? How do you make that happen?
It's the idea around it of building an entire plan for somebody. You know, just to have somebody walk in and say, how should I have my money there? Everybody that walks in the office is going to be completely different when it comes in for that. And I'm going to ask those questions. I usually ask a simple one. If a scale of 1 to 10, 0 or 1 is I am totally risk adverse. Money markets and cash is where I want to be, or I'm aggressive as you can possibly be in the market at 10. If you couldn't pick 5, where would you pick? That gives me that idea if that person in their general overall market philosophies is a more aggressive person or a more conservative person. And then I look at building portfolios that are not every one of them are built exactly the same. If you've got money that's sitting in a Roth IRA account, I look at that. I've got your lifetime plus 10 years for your kids to keep it in that tax-free growth model. My time frame is very large. I'm going to be a little bit more aggressive there. My IRA accounts, I might be a little bit less aggressive there. Why? Because I'm looking at markets and they got this little things called required minimum distributions. And I don't want to have a thing that heavily fluctuates. I don't want a real high year-end balance and then a negative year, and I got to take it from a declining market. So I want a little bit more consistency in that IRA account. And I am going to be a little bit more aggressive looking at the tax side of it for non-qualified money. So it's a big idea of where are you at, what risk are you willing to take, and what reward are you willing to get for it. So that's what we have to look at all of those things when we build a plan for somebody.
Financial author and speaker Susie Orman, she is constantly warning people about retirement. Her latest is, if you think you're ready to retire, think again. She says for most Americans, their savings will only last about 3 years, and that the greatest threat to your comfort in retirement, it's not the stock market, how much you've saved, or exorbitant spending. It's not having a plan. So have you met with people who have been good savers, but they're headed for problems just because they don't have a plan?
I think the idea of the plan is when we have times like now. It's when we have a lot of uncertainty out there and we've got a 24-hour news cycle so people can focus on a lot of different things. And I am very high on the fact that whatever your biases are, if you think the market's going to be fantastic in the next 12 months, you're going to find authors that agree with you. If you are very pessimistic about the market, you are going to find people who are pessimistic about the market right now. So we look and find our own biases. So our own biases can get us focused in the wrong direction. And I think having a plan is important. And I think the plan has to talk about more than just the market. You know, a plan. What should that plan include? It should have income. How are you going to replace your paycheck that day that you decide that retirement is there and your paycheck's never not going to be coming in anymore? How are you going to replace the income? I think that's the most important thing that we look at. Mm-hmm. A lot of people, when they come in, it says, Steve, I want to look at that income plan because my guy doesn't really have an idea of what it is for income. Social Security optimization. Some people think it's just a simple deal. I'll retire and I'll turn on my Social Security. Optimizing Social Security can be very, very, very important. And when we look at optimization, it's as a couple if you're married. It's not just about you. It's about, God forbid, when one of the two of you not there, what does the survivor get? I think that's important. Tax strategies. I'll say it over and over again. I think reducing or eliminating taxes is the greatest thing you can do for your retirement. It's the best thing in the world, because if they double the taxes and almost all your money's in non-taxable accounts, it doesn't matter. If they double taxes, 2 times 0 is still 0 if you've got money in Roth accounts. Legacy planning. Most of us didn't plan on passing assets to our children, but we're going to. How are we going to pass those assets to our kids? Those IRA accounts, they told us when we put them in there, grow tax deferred. When you die, it'll go to your kids. They can stretch them over their lifetime. That's not true anymore. So I think all of those things are very important. And your investments. Investments should be based on need, not greed. Give me the best return that I can get with the least amount of risk possible. If you've got a plan when all this noise is going on, it gives you something to focus upon. Yes, this is going to be a crazy year. We're not sure what the Federal Reserve is going to do. Inflation is high. We've got an election. We've got problems in Israel. There's a lot of stuff that's going on there right now. How are you dealing with it? Do you have somebody that you can talk to or ask questions to? We give that to our clients where they can come in 4 times a year for new clients. After that, we give the clients the availability to do it, and they can call at any time if they start to get uncomfortable.
There was a recent poll that found that nearly 60% of retirement savers are concerned about outliving their assets. That's one reason why more are looking at annuities as a source of guaranteed income. But many financial advisors still find their clients lack interest in these products, even if they're asking for safer portfolios with income protection. So what is the deal here, Steve? How can we demystify annuities?
I don't know. I mean, we're a full service firm. So I'll look at it to the point where if you come in and all you're looking for is to somebody to manage your investments, assets under management, we can do that. We do that. I also do life insurance because I think it can be very, very important when we're talking about legacy planning. If somebody has possible tax issues or to help cover those long-term care events, insurance is what does that. And then the annuity world. I know when I say the world of annuities, some people out there grow horns. I can feel it when I'm talking on the radio. You can just watch people grow horns, and I've got the people, they'll come in and they'll do the comprehensive retirement plan and they'll sit down across the table from me and I'll say, Steve, I can talk about any what you want. And they'll go, but I hate annuities. Don't talk about annuities. And I love to just look at them. I hate annuities too. Which kind do you hate? And they look at me like, what do you mean, which kind? Because everybody's got that story of somebody that came along. Uncle Joe bought an annuity. He died 5 years later. The insurance company kept the money. Those things happened. Or there's great big fees in these things. They pay the advisors just ungodly commissions. And then if I leave, I got to surrender the policy. And that is true. The industry had some very bad products for a very long time, where guys were getting paid exorbitant amounts of commissions. So that you have these problems that people have. But the annuity world has changed. That would be like saying my 1975 Ford Mustang II was a terrible car. Well, I wish it wasn't the Mustang II and it would have been the Mustang. They're just different cars. And what's the job when we get to do it? And we start to look at annuities, and we go, okay, what kind of annuities are they? That single premium immediate annuity where you do hand your money to an insurance company and they're going to pay you an income stream for the rest of your life. If you do it for your spouse, that's both your lives. Looks like a personally funded pension very quickly. Now, just like pensions, The insurance companies looked at it and say people didn't like the fact that if they died a week later, the insurance company kept their money. So now they have period certains. Those can be for 5 years, 10 years, 15, 20. They give you more options than they did a long time ago because that was a major complaint. Then they have the fixed annuity. The fixed annuity says we're going to give you a set percentage for a certain period of time. So it might be X percentage for 5 years. Mm-hmm. Looks a lot like a CD, but a CD is guaranteed by the banks and the Federal Deposit Insurance Company. Then you go over to the annuity, that's guaranteed by the insurance company. So slightly different on the guarantees, but they look a lot alike. Variable annuities. Variable annuities got a bad rap because of the fact they had very high fees inside them because somebody's actually managing the money. So that the fees were what gave some people the problems. But some people like them, tax deferral. Mm-hmm. And then when I pull the money out, it's tax deferred. So there are different tools, and then the fixed index annuity. And then we look at the fixed index annuity. Your money's not at risk in the market. It cannot go down due to market volatility. And some guys, it's the end all be all, and that's all anybody should ever have. But they all have problems with the fact of there's limited liquidity to these things. So you have to be careful. And then I always tell people when you hear the word rider, just automatically think, what's this going to cost me? Because riders usually cost money. Well, if I buy an income rider that says I'm going to turn on the income 10 years from now when I retire, I'm going to have to pay for that because they're going to keep paying me that money even if the account balance goes to zero. Mm-hmm. So knowing what you're getting is very, very important. And as I say, I really don't hate annuities. I hate annuity salespeople. I hate it when one of you all bring into me an income annuity, and we look at your income, and between your pensions and your Social Securities, you've got more income than you're currently spending. And I've got an annuity with an income rider attached to it. That kind of upsets me when I see that. Why did we buy this? Has there been a change? So those are the things that we need to look at. I think the right tool for the right job, you can't do anything better. If you've got a gap between your current income and your lifestyle expenses, how could guaranteeing that payment with a personally funded pension not be good? I haven't figured that one out. But if you've got a, quote, more income coming in than you have expenses, I don't think you should pay for an income rider. That's where I'm looking at. So I'm looking at it if you've got an annuity and you're not sure exactly how it currently fits within your plan. You bought it a while ago. You haven't turned on the income rider. Give me a call. Let's find out. Can it be replaced? Why? Because some of the fixed index annuities were bought when the interest rates were real low. Well, the interest rates are higher right now. So they are giving better deals. You might have to accept a longer surrender charge, but there are things out there that you could look at. And my statement is still exactly the same. The right tool for the right job. If you're looking for protected growth, that's one product. If you're looking for income guaranteed for you and your wife, that's a different job. Give us a call now. If you have an annuity, ask for the annuity x-ray. And if you're not, just ask us about, I'd like more information on how annuities might fit in your financial plan.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any government governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.